Go.
Hello and welcome to Idea to IPO. My name is Jennifer. Idea to IPO has been holding tech startup events in Silicon Valley for many, many years. We organize venture capital panels, legal workshops, networking events, and more. Please check out our schedule at ideatoipo.com. Our featured speaker today is Roger Royse, one of the top venture capital attorneys in Silicon Valley, and he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Roger Royse. Roger, take it away.
Okay, thanks very much, Jennifer. Thank you for that introduction. My name is Roger Royse. I am your speaker today. I'm a tax and corporate partner with the law firm of Haynes Boone in Palo Alto. I work with emerging growth and venture capital. So today we are going to talk about how to prepare your startup for venture capital investment, part one. Before we get started, I guess I would like to tell you a little bit about how the morning will go and how the presentation will go. I've got an hour of content that I'm going to cover. And at the top of the hour, I'm going to open it up to questions. So if you have questions as we go along, use that Q&A dialog box at the bottom of your screen, or maybe if it's on the bottom of my screen anyway, but go ahead and type your questions into the Q&A box. Don't use the chat box for that. Use the Q&A, and I'll take the questions at the end of the presentation. This event is sponsored by Idea to IPO. We are Zoom casting all around the world, and slides will be available, and a video recording will be available probably later today, as well as a soft copy, a digital copy of my new book, 10,000 Startups, Legal Strategies for Startup Success. In fact, this is just now being released. It was in pre-sale up until this month, and now you can actually buy a hard copy if you want one. If I see you in person, I'll even sign it. How's that? All right, before we get going, the chat feature is enabled. Everybody can talk to everybody else. Feel free to share your LinkedIn or other contact information on it if you'd like. I'll do that by the end. But before we get going, let's do a couple of polls. I'd like to know who's in the audience. Who are you? Are you a startup entrepreneur? Are you an investor, advisor, student, media? Let me know who's out there, because it does inform actually how I present things. So it'd be good to know. While you're doing that, so far it's about 75% startup entrepreneurs. We got a few investors, several advisors, a lot of service providers. And here's how you can find me in the chat while we're doing that. Okay, well, it's a little less than a minute, but with 76% participation, we have about 80% of you are entrepreneurs. Quite a few of you are advisors and a lot of service providers today for some reason. Okay, good to know. I have another question. I'd like to know where you're from, because again, that will inform a lot of what I talk about. Okay, let me open. Someone's already asking questions. All right, awesome. So where are you from? Are you Silicon Valley? Are you someplace else in North America, Europe, Asia, India, Africa, Latin America, South Pacific? Is that a choice? Let's see here, Asia Pacific, or someplace else. Please let me know where you are from. And we'll let the poll stay open for a little bit. And if you're tweeting today, because I hear that Twitter is changing hands, use hashtag Idea to IPO and try not to get blocked. Okay, with about a minute here, we've got, I can see that we've got about 18% Silicon Valley, more than 50% other North America, 13% Europe. It's a big Europe crowd. 3% Asia, 7% India, 2% Africa, 2% Latin and South America, 2% Asia Pacific, and 2% others. So we're all over the world today. How about that? Next time, maybe we'll do it a little earlier and see if we can attract even more folks. Okay, if we're ready. I am going to share my screen. Whoops. All right, now you should see one. Give me a second here. Give me a second here. All righty. Awesome. You should see one slide that says how to prepare your startup for venture capital investment. Somebody send me a chat. That's the slide that you see. I want to make sure this is set up right. Just yes, no, not there. Not yet. All right, that's what I was afraid of. Okay. How about now? Okay, can you see my screen? Okay, awesome. Okay, we will get going. So welcome again. I'm Roger Royse, a tax and corporate partner with Haynes and Boone, work in emerging growth and venture capital in Palo Alto. Today is how to prepare your startup for venture capital. So we're going to focus on venture capitalists today. I know normally when I do these presentations, we talk a lot about angel funding. We talk about other sources of financing, but today we're going to try and focus on how to prepare for venture capital. It's two parts. We'll get more into terms next time we do this, but for now it's a little bit more prefatory. So we're all the way through April of 2022. I can tell you that 2021 was a record year for startup investment and exits. The numbers were really high, record highs. Every year it's record highs, and we say it can never go any further, and then it goes further. And it goes further by quite a lot. 330 billion in the US, 17,000 deals, according to PitchBook, in 2021, twice what we did in 2020. And 2020 was also a huge year. So you can see there's a tremendous amount of venture capital in the system. 100 trillion in private equity investments overall. 80% of that is going to smaller companies. So keep that in mind. A lot of exits, right? A lot of exits, IPO as well as SPACs. And that's good. When there's a lot of exits, that really fuels venture for some reason. It frees up more capital, it creates more liquidity, gives them a little more powder. So exits are a good thing. That also, not only that, but serial entrepreneurs will go ahead and start up new startups, they'll do acquisitions. It's always good to have a lot of activity, and there is a tremendous amount of activity in the system right now. And I'll tell you, I have not seen it slow yet. I saw the jobs report, I saw the economist report. You know, I see that inflation's as high as it was since I was, well, I wasn't young, but since for a long time. And interest rates are just going to have to go up. So we're all expecting a downturn at some point. Haven't seen it yet. I sense that people are nervous, of course. Valuation of VC-backed companies, look at that, tremendous amounts of valuation out there. And here's probably the most important number to you folks, is that there's this thing we call dry powder, right? What do I mean by dry powder? What I mean is there's a lot of money that's out there in the system ready to invest. So now is a great time to be seeking venture capital. Here in the Bay Area where I practice, and I know, I guess about 20% of you on this webinar are from the Bay Area, we've also had record numbers in 2021, $30 billion just here in the Bay Area, in my area, 88 billion in all of, and that was in Q3 of 2021. I probably should have Q4 numbers by now, but 88 billion in 2021 by Q3, about 100 billion. I believe it was over 100 billion in the Bay Area just last year. Alrighty. So one of the things that I've noticed that I do want to mention before we get too far into this and talking about preparing for venture capital investment. I'm a lawyer. I'm going to talk about a lot of legal stuff, legal and structuring. It's just the personality defect of mine we're going to have to deal with here today. But also a lot of companies say, what can I do to make myself more attractive to a VC investor? And we do a lot of panels here at Idea to IPO on venture investing and venture panels in various sectors, ag tech, fintech, health tech, energy tech, which is now climate tech. And one of the themes that keeps coming up over and over again is ESG investment. And that's ESG, environmental, social, government. And the E is usually the most important letter in that ESG. Funds are looking for socially responsible investing, also called impact investing. So there's a lot of names for it now, as you'll see, sustainable investing. And companies that can add a sustainability component to what they're doing tend to have a real advantage in the marketplace. And by ESG, companies are, venture capitalists are definitely paying attention to all of this. Like these days, the due diligence lists have a lot of questions about governance. They want to know about your policies. Like, what are what's your policy on this? What's your policy on, making sure you don't have slave labor products, components in your products, et cetera. But also there's a lot on the environmental side. So just keep that in mind, that if you have really good governance, if you have a really good social component to it, if you have good environmental controls in your company, you're going to increase your your attractiveness out into the market. And just to pause on this a little bit more, because I don't think I can understate this. This comes up so much. There are different types of screens. So think about negative screens. Number one, what do you not want to be doing that might dissuade certain investors? But also the more positive screens. For example, with bigger companies, in fact, you've been hearing a lot about public companies being urged to report their own ESG. For example, their environmental, what's their carbon footprint? How is that going to impact their company? How's it going to impact their earnings? What are they doing? So just keep this in mind. We won't dive down into it today, but I do want to tell you this is something that you might want to think about. As I was saying, what does that mean? Ethical business practices, compliance procedures, AML, KYC. That's part of it. Okay, second thing I want to mention is that 2021 seemed to be all about NFTs. We started doing live events here earlier again this year, and I was really surprised at how many companies are out there that have added a blockchain component to what they're doing. Now, part of that was, I think, driven by supply chain problems in 2020 because of Corona. And I saw a lot of companies looking for ways to deal with that. Some of those were around supply chain. Some of the excitement's been triggered by all the volatility in crypto. I think that may be a negative thing. Although I have seen tokens, well, we saw a lot of people get rich quick, or we heard about it. Let me put it that way. I think that spurred a lot more interest. Unfortunately, the SEC has not advanced the cause at all. If anything, it's become more restrictive when it comes to blockchain projects. But we did see the rise of NFTs, non-fungible tokens, which honestly, I think have been around for a long time. They just got a cool new name now, and they've been packaged a little bit differently, usually built on Ethereum, not always. And most of the time, they represent digital ownership. One of the reasons these are so popular, I think, is because a lot of people are taking the position that they're not regulated by the Securities and Exchange Commission. Sometimes that's right, sometimes that's not. I think a lot of people, from my standpoint, are simply not complying with the rules. I do several presentations on this, full hours, in fact, multiple hours of this on my YouTube channel, if you want to take a look at it. And the problem with this entire area is that there may be 100 companies that skirts the laws and doesn't treat their token as a security, and they have no problem at all. But then there's that one, that does get caught. So this is a very tricky area. I will tell you that in the marketplace, pure NFTs that represent nothing but digital ownership of an asset like an art piece, people I think have gotten pretty comfortable that those are generally not securities, although it's a little hard to get there when you look at the case law, but I think people have gotten comfortable with that. That's all I really need to say about that. I will say one other thing. It does raise just a host of other legal issues, copyright issues, etc. But nevertheless, the point is that this is a hot sector right now, and it doesn't seem to be going away, at least from where I sit. Check out this article. I'm sure everybody here knows what an NFT is by now, but if you don't, this is a really good, I thought this is a really good summary. Now, some of the successful sectors that I've been seeing in the market, I mean, we talked about one of them, which is what people are doing with digitizing and tokenizing. But the other things that seem to be doing really well, I'm not going to talk about all these, but a few of them that I see in my practice. Number one, ag tech. Agriculture technology is probably what I do most of in terms of representing startup companies. And it just keeps getting bigger and bigger and bigger every year. And interestingly, it keeps taking a bigger and bigger piece of the total venture pie every year. And that tells me that more venture funds are drifting into this space. And by ag tech, I mean ag and food, right? Ag and food. And we saw a whole lot change in e-grocery last year, and in food delivery and home delivery and farm to table type solutions. I mean, that was a huge growth, right? I think a lot of us, probably all of us, started using these solutions that we didn't before. And by e-grocery, I'm going a little bit beyond just delivering from, the grocery store to my home. I mean, also technologies that keep food fresher. There are stocking robots in stores. There's self-checkout. There's just a lot of technology that are really improving the food supply, reducing food waste, which is a huge problem in this country and in this world, and helping increase production and reduce costs. So ag tech is really growing. And by the way, within that, not only food tech, but there are some sectors of it that have just really kind of, have really expanded. It was all about robotics a few years ago. I think it's vertical farming now. Urban farming seems to be getting there. Things like that. SynBio, of course. I see so many plant protein companies or synthetic proteins, synthetic bio solutions. So anyway, I don't want to spend the whole day talking about ag tech. I think it's a big sector. So the other one that I see a lot is cybersecurity, right? Especially now because of events worldwide. I think we're all on heightened alert about cyber threats, and cybersecurity companies see that as an opportunity. I see a lot of interest in really good cybersecurity solutions. Energy tech, all right, and I guess we call it climate tech now. There's a time we called it clean tech, then it was energy tech, and now it's climate tech. But this is something that I'm seeing more and more of. I'm seeing a lot of money going into this. One sector within this that I've noticed is carbon sequestration, right, or carbon capture. It seems to be attracting a lot of interest, and I'm just seeing even agricultural companies are adding this to their bag of tricks that they can do carbon capture. So energy technology. And by the way, what we're seeing is, because we do a lot of work, my firm, in the energy sector, and we're seeing large traditional energy companies really investing in other technologies that 10 years ago would have been considered alternative energy, things like geothermal, right? Even I heard Elon Musk just yesterday in his TED Talk talking about clean tech and the future and how important energy technology is going to be. He mentioned wind and solar. He pointed out this problem, but what if the sun's not shining and the wind's not blowing? So he's a big fan of nuclear. I got to tell you, geothermal will solve that problem. And I'm seeing money go into this year in geothermal like I haven't in 20 years. So I think that's going to be another big growth area. And then finally, the last thing I'll mention, precision medicine. I'm reading Tony Robbins' book right now, Health Force, I think it's called, 600 pages about precision medicine. And whether you're a Tony Robbins fan or not, I don't know if you are or not, I think you'll love the book because it's talking about what is going on in precision medicine and medical technology. And I can promise you, you are going to be blown away by what is going on in that space. The time is right. We have a limiting factor here. You might have seen in the papers that there was a bipartisan study that concluded that our Food and Drug Administration is a little bit too slow in getting things to market. So, hopefully that's changing. We saw what they can do with the COVID vaccine. Maybe they can do that with some of the therapies that exist and are out there. They're just not on the market yet. So enough about that. Let's move on. All right, so kind of drilling down into some detail here. Let's talk about some basic principles to keep in mind when you're thinking about venture capital, when you're thinking about investors generally. And I talk a lot about this in my book, which you're going to get a soft copy of, and you can get a hard copy of as well because it's now out. But number one, your investors are your partners, okay? They are your partners. Think about that. I know that especially when you go to VCs, because by the time that you get to a VC, you've probably talked to, first of all, your friends and family who just give you money and hope you do okay. You've probably talked to your angel investors, many of whom are very passive, right? They've got small stakes in a lot of companies. They can't spend a lot of time harassing you. So they leave you alone for the most part. So you don't really view them as a partner so much. You give them a report once in a while, you don't think about it. But wait, and then maybe an angel group, which might act the same way. Now, sometimes you get more activist angels, but for the most part, they're nothing like what VCs are going to be. Your VCs are going to be your partners. They're going to want representation on your board of directors. They're going to want additional observer seats. They're going to want to have a say in what you do. They're going to want to have control rights. You have to think of them as your partner, even though you're only giving up maybe 20 to 40% of your company. When you do the financing, just kind of get that idea in your head from the start. And the reason I say that is because I work with a lot of startups. I work with very early stage, and I've seen this many times over the years where the startup takes the money and they go back to business as usual. And they have that very rude awakening at the first board meeting when they say, wait a minute, you don't expect us to have this many board meetings, do you? You don't expect me to send you reports that often, do you? And the answer is, hey, you took outside money, read the documents, we're your partners. So just kind of get that in your head to start with. Second big basic principle I want you to think about is staging. Stage your financing. Here's a scenario. Again, I've been through it with companies. Somebody comes along and they say, hey, I've got a great idea, but I don't want to spend all of my time fundraising. So what I'm going to do is I'm going to go out and just raise $50 million in one round, and that'll be the end of it, and then that'll last us until exit. Well, a couple things about that. Number one, no, you're not. World doesn't usually work that way. You got to get a little bit of traction before you can do anything. And it takes a little bit of higher risk, earlier seed money to get to that traction. And number two, even if you could do that, you would not want to, because you would be giving away far too much of your company at way too low a valuation. You want to stage your financing. In other words, you take a little bit of money, just enough that gets you to the next valuation event. And hopefully that's a year, year and a half, 2 years away. So you've got some runway. And runway is just the time it takes you that you can survive on the money you've got. So you've got some runway before you have to go out again to the investors, because you're right, it is very distracting. But you want to have enough money that you get to the next thing that's going to happen in your company that's going to increase your value, hopefully double it. That's what we're targeting for. So those are just rules of thumb. Use those as your targets, right? Next valuation event, double your value 1 to 2 years away. What might that be? Might be a governmental approval, like an FDA approval. Might be a release of a new product, right? It might be some other metrics. It might be a tape out. Whatever it is, you stage your financing, you raise just enough money. And it has been my experience that companies that are really super successful, the unicorns that I've counseled over the years, they were expert at doing this. They got this right away. Oftentimes they got it so much that they would not even let their lawyers invest in their financing because, oh no, we only need this much. We don't need this much plus your $10,000, they were very disciplined about this. They staged the financings. So keep that in mind. You're going to go out for just enough money to get to the valuation event. So figure out what that is. And of course, it takes somebody above my pay grade to help you figure out what that is and when, but just keep in mind that that's the general idea. Thirdly, and this might sound a little obvious, but it's a concept that, pardon the pun, is getting diluted because of the types of financial instruments that are out there. But most funding is going to be dilutive. What do I mean by dilutive? I mean, it's going to reduce the percent interest that you have. Now, before you say, well, duh, of course, it's obvious. Let me tell you why I'm pausing on this. Number one, a lot of people, well, almost every company, certainly every company in Silicon Valley now is using an instrument called a SAFE, a simple agreement for future equity. All right. I talk a lot about it in the book. If you want to hear the good and bad and the ugly of SAFEs, hopefully we'll get to it in this presentation. But the basic idea is the investor gives you money today, you give them equity later. Depending on the type of convertible instrument it is, and by the way, it's a SAFE here in Silicon Valley, it's convertible debt, most of the rest of the country, it seems. But depending on what type of convertible it is, you may or may not know, the investor may or may not know how much equity they are going to get in that next financing. I'll talk more about that later. But if you have a typical, my favorite pre-money SAFE that I like to use when I'm on the company side, then you don't know how much they're going to get. So the company is going around along selling these SAFEs, these instruments, taking the money, not issuing stock. It's just this instrument that converts the stock. So they might not be thinking about the fact that they're diluting their interest. So that's why I want to say you need to think of even SAFEs as being dilutive. So that's the first thing. The second thing, there's other funding out there that is generally referred to as non-dilutive that you should just be aware of. Okay, the most obvious, of course, is revenue. If you can get the revenue, that's perfect. It's non-dilutive funding. Another type is government grants. There's a lot of government money in the system. That's a whole other program. It's another talk for another time. There's a lot of money. And then there's another instrument that's getting to be very popular. And those are, they're basically we used to call it royalty financing. And now it goes by a bunch of different acronyms. But the idea is that the company will sell off a revenue stream, right? So think of it as royalty financing. And we call it royalty because you're basically paying, the investor gives you money and you give them a percentage of revenue from either your company or from a division or from a product or something like that, subject to term limit, subject to a cap. We could do a whole hour, right, on those sorts of loans, those sorts of investments, that sort of financing. And I have done those deals, and it's actually might be the right deal for your company. Again, it's not venture, but it's something that might get you to venture. It's way different than venture because, first of all, it's way more like debt, but you're guaranteeing your investor a certain percentage. So they're going to get their money back earlier. They're not going to have to wait 10 years until you exit before they get paid. They're going to take a smaller return, but a more certain return and an earlier return. It does not dilute the equity, but I'm pausing on it because you should just know that if you do go to the VCs after doing something like that, the VCs will view that as debt. And you generally want to keep your debt as low as you can because the debt ranks ahead of the VC in the preference stack. In other words, the debt gets repaid before the venture capitalists do on their preferred stock. But just keep in mind those instruments are out there, and you might be right for it. Another interesting concept I want to tell you about. And again, I'm kind of focusing on the counterintuitive issues, but everybody is like so focused on valuation. And I'm not saying you shouldn't pay attention to valuation and have your ear to the ground and knowing what the market is doing. But just keep in mind, valuation when you talk to a VC is not your biggest issue. You know, it's up there, it's one of the top issues, but you want to look hard at the term sheet, right? And you can go through some examples. I got some books at the end of these slides that written by venture capitalists who will tell you the same thing. Look at the terms, you know, and do the what ifs. And we'll talk more about that later. But you might get a big valuation, but really, you know, really investor favorable terms that leave you with less money on the back end. Okay, that's one point. The second point is that don't think of it in terms of ego. Don't think of it in terms of what you're worth. That's not how VCs think about it. VCs think about valuation as just math. It's just a metric that helps them determine how much of your company they are going to have, you know, and how much they might expect to have at an exit. You know, it doesn't have much to do with what you think you're worth. Now, you know, I talk about how valuation not being the biggest issue. And if you've been to our presentations before, you've heard the story that I've told of one of my clients from many years ago, founder of a company, one of 3 co-founders. That company was sold, it exited, took them 10 years at least, probably longer. And by the time they exited, the founder was long gone. But they exited at more than $500 million, which even today is a pretty good exit. You know, when this happened, you know, this happened to me 10 years ago, happened to the founder 10 years ago, that was a pretty outstanding exit, made the papers. The founder took 0 home from that deal. Big valuations, but really bad terms in the venture documents that she had negotiated. So keep in mind, you know, valuation is important, but keep your eye on the other aspects of the term sheet. And we're going to talk about that in part 2, what those gotchas are and how to avoid those issues. So speaking of mistakes, you should avoid early mistakes, I guess is the only way to say it. What do I mean by that? We do a whole presentation here. You can see the videos on YouTube on how to prepare your startup, how to create a startup, but there are some super early mistakes. I wrote a whole book about it. It's called Dead on Arrival, How to Avoid the Mistakes That Could Kill Your Startup. Not putting vesting on founder shares, for example. Not getting your founder split right might be a bad mistake. Not securing your rights in your intellectual property, right? Giving away your intellectual property early in a company because you signed that form that big company sent to you. And you thought you were providing a service and you ended up giving them the crown jewels. Those are early legal mistakes. And I'm pausing on it here because it is so super easy to make a mistake now because anybody can go online and just do it themselves. All right. Anybody can go online and download, they can buy a corporation. And you think you'll have this false sense of security that you think you've done everything that you need to do. Almost anybody can mess up their IP protection because you can do that online now. Almost anybody can mess up their securities compliance because you can go online and download forms that allow you to sell securities. I've met 2 people now in my career that I've talked to that are sitting in jail or spent jail time because they just did the security stuff themselves. There's more to it than that, obviously. There's a fraud component, but had they been counseled, they never would have made those mistakes. Liz Holmes might disagree with me on that point, but I think if you're counseled by a lawyer, you won't make a securities mistake as a general rule. So just avoid those mistakes. You know, I'm not saying don't go consult resources, but definitely come to presentations like this so you can get an understanding of where those pit holes, those potholes are, you know, where those rattlesnakes are on a trail that might bite you along the way, and make sure you get counsel as soon as you know you're going to be successful. Cheap money over expensive money. We'll talk more about that later. just a couple of more practical points. Save your common stock for your service providers. Don't sell it to investors. I'll talk more about that later. Here's another one, get a data room, do it early, and just start getting organized early in the process. I guess the first, 6 of these are more platitudes. The last few are kind of practical stuff. Okay, we're not going to talk about this, but I want you to know there's a lot of funding available before you even get to the venture capital stage. Friends and family, angel or seed investors, incubators. I don't have venture studios up here yet, but there's just lots and lots of sources of money. I gave you the venture capital numbers earlier, but there's a tremendous amount of money in the system everywhere. Just look at our inflation rate. That ought to tell you something. There's a tremendous amount of money in the system now coming from all sources. I don't have SPACs on here, but that's another place where we're just seeing money being pumped into the system that's competing probably with private equity. And all of us are doing SPAC deals now. So there's just a lot of money, I guess, is the point of the story. So before we get into the venture stuff, I want to mention that. I do want to pause on debt financing. So, well, I'm going to pause on a couple of these, but debt financing in particular. In my world, I work with tech startups that are on a path to venture capital and an exit through an M&A or maybe a de-SPAC transaction. In my world, my clients, they don't have a lot of debt. If they get bigger, they might do venture debt, which is a kind of a very, own peculiar thing. But for the most part, they don't get a lot of bank debt. If they do, it's because it's guaranteed by the founders. A high risk endeavor, if you ask me. And the reason they don't get debt financing is to take a step back, is because venture-bound companies are not good candidates for debt. And companies that are good candidates for debt financing are not good candidates for venture. It's almost like two different worlds. I'm sure they sometimes collide and there's a center of the Venn diagram. But for the most part, we're talking about two completely different worlds. Why is that? Well, think about it. To get debt financing, that means you have to have a means to repay the debt. It means you probably got to have cash flow, maybe even income and EBITDA. I think your banker is going to want to see that. That means that you're putting money into current revenue. You're not putting your effort into building a huge asset that you're going to just build and build and build and sell way down the road in a capital transaction. That's a debt financing transaction. Another way of saying that is you're really sacrificing growth for current earnings. That's the opposite of what venture-backed companies tend to want to do. They want explosive growth. They want massive growth. They want you to be able to scale. You're going to hear that word a lot. Are you scalable? And to scale, you oftentimes, well, these are generalities. I'm sure you're going to find exceptions for me. But to scale, you oftentimes have to sacrifice current profitability and current cash flow to build that asset. Just look at some of the biggest companies, the biggest venture finance successes in the world, and just think about how long they were unprofitable. Twitter, Facebook, Snapchat, PayPal even, unprofitable for a long time because they're building that user base. So those are generalities, as I said. I have companies that are profitable that are going to be great venture candidates, but for the most part, it's two different ways of looking at things and two different ways of thinking. So I don't see a lot of debt financing in my world. That doesn't mean never, I'll just say not that often. All righty, let's move along. I'm going to jump into, is there anything else here we want to talk about? Not right at this, well, I will talk about one other thing, because crowdfinancing and crowdfunding has gotten more and more popular now. In 2012, President Obama signed our Jobs Act into law. And the idea was that it would make it easier for small businesses to raise money in the markets. And there were a host of provisions. Some of them made it easier to do large financings, the Reg A plus deals over 50 million, now 75. Some of them made it easier to do accredited only transactions. You could solicit and you could, like AngelList, you could publicly go out and promote your company if you only took money from accredited investors. We'll talk more about that later. But the one that really was interesting was the crowd financing, also called crowdfunding, also referred to as Reg CF deals. And as originally enacted, the idea is that a company could raise up to $1 million adjusted for inflation within a 12-month period from a lot of people who didn't have to be accredited. They just had to be on a portal, an SEC approved portal, which is like a broker dealer. And at the time, those were very expensive deals. First of all, you had to take just very small amounts of money. They're typically capped at a couple $1,000s each. It was expensive because you had to be on a portal. They cost a lot of money. You sometimes had to have audited statements. You had to make a filing with the SEC. You had to have a big business plan. It was a lot of work, and a lot of lawyers, including me, said, let's not bother with that. Plus, who wants 1 million small shareholders on your cap table at $1,000 each? Let's pass on that. Well, the world's evolved. I've gone from a skeptic to, I guess, a supporter of crowd financing because I've seen it work well. The other thing that didn't happen, everybody said there's going to be massive fraud in the system because of this. That didn't happen either, oddly enough. And the third thing that everybody said, including me, is that the VCs are going to hate this. They're not going to fund your company if you have crowd financing. And I sat on many panels, where I listened to VCs say that, don't do it. I don't want you to have 100 or 1,000 shareholders by the time I invest in your company. That didn't happen either. I've seen lots of crowd finance companies get VC financing. And let me tell you why. Currently, under current law, you can raise up to $5 million crowd financing. That justifies all those costs I was talking about. The lawyer, the broker, the accountant, the promoters, that justifies the costs. So that's worth it. Secondly, we're seeing crowdfunding rounds collapse now into custodial arrangements or special purpose type arrangements or vehicles. So you don't have to worry about dealing with 1 million, small shareholders. Now, I want to warn you, there are some legal issues here in crowd financing we're not going to get into today. All right, I'll slow down. That we're not going to get into today. There are some legal issues about those crowd-funded instruments converting into stock in your venture round, but there's ways to deal with that, right? There's ways to deal with that, and the market has figured that out. And then finally, the crowd financing rules or crowdfunding rules have now changed, where the SEC allows what they call testing the market. So you can go out and you can go ahead and find out if people are really interested in your company before you commit to it. Yeah, we're going to have a recording available. I'm watching the chat. I know I'm going pretty fast here. I'm trying to get through some of this information. The slides will be available in the recording. Okay, so where I start with the VCs, because people come to me and they say, hey, I want to meet so-and-so, or who should I go talk to, or how do I approach a VC? What do I tell them? And I say, well, let me give you some inside baseball here. Everybody's got your huge, beautiful pitch deck. We'll talk about that in a minute. And I got nothing against pitch decks. But you're talking to a busy VC who's going to look at, God, we had a guy on our panel here recently. He said he sees 300 deals a year. And of those, well, I don't want to tell you how few he finances. That's a lot of deals, right? That's a deal a day. He sees a lot of them. So, you're not going to get a lot of their attention. So I like to start with a very simple, pithy executive summary, right? A very pithy executive summary, just the facts, right? What are you doing, right? What's your mission? What's your business? Who's your team? Because team is so important. What's your product? How much money have you raised? What are you going to do with our money after you raise it? So that's where I start with the executive summary. And it just, because if the person you're talking to absolutely doesn't do biotech, I think, you guys want to know you're not a fit, without them having to read a huge pitch deck. So just the executive summary, that's kind of the obvious extreme example, but let me give you a better example, because this happens more often more recently, a lot of VCs now, because, well, it's just the way they are, they may look for certain metrics. Annual recurring revenue is one of them. They want to know you have X dollars of annual recurring revenue. They want to see year over year growth of some factor. All right, those are their metrics. Let's just serve that up to them right away, on a plate, so they don't have to sift through, dozens of pages of financials. So the executive summary. All right, let's move along. And then, you'll get a copy of this, so you can take a look at the other things that I think are important. I've got a fill in the blank one in my book, which I'm going to be sending to you. So I'll make that really easy for you. But you are going to get into the point where they are going to want to see a pitch deck, right? And I'm not going to give you a presentation here on how to do pitch decks. First of all, it's not my area. There are a lot of people who do it a lot better than me, and there are a lot of people out there that do this. I will say, however, I have seen a lot of pitch decks, and I think there's a lot of art in this. In terms of content, it's all the stuff you might expect. All the stuff that's in that executive summary, just really expand it. But here's where some people disagree with me on this. Well, on two things. Number one, I really think your pitch deck should look nice. Okay. I think it should be well designed. And I know some people say, don't waste a lot of time on design, just get to the content, because people are going to want to see content. Yes, I'm a big believer in content, but I sat in one meeting with a big brand name VC on Sand Hill Road, and we went through the pitch deck, and and the founder said, well, what do you think? And the first comment out of the guy's mouth was, I think you should get a professional designer for your pitch deck. Not a good start. Okay, you didn't make a good impression. They're distracted, on how much they don't like about the deck. They're not even getting to your content. So make sure you clear that minimal hurdle, of having a good looking deck. And I'm not saying you personally can't do it yourself. Just make sure it looks good. Secondly, and this is more of a substantive point, resist the temptation to tell them what you're worth, right? Okay, I really don't, even in the executive summary, I really advise people don't talk about valuation. It's just the wrong time and the wrong place. Ideally, negotiation 101, you would like the VC to give you a valuation. And I know that there's this idea out there in negotiation world that you want to anchor the discussion by throwing out some ridiculously high number, knowing that you're negotiating from there, but setting expectations. I've not seen that work in this sphere. You're dealing with people who are far too sophisticated to fall for that, right? In fact, what will happen is if you give them a valuation, if it's way too high, they're going to recognize that and they will dismiss it. It's like making no presentation at all. In fact, it hurts your credibility. If you give them a valuation that you think is realistic, they're just going to cut it in half. That's just the way it works. Just trust me on this one. And that's just been my experience. You want to defer that valuation discussion till later. Now, if there does come a point where you do have to talk valuation, and usually the VC tells you what you're worth, but if they want you to come up with some numbers, I've got a whole system for allowing you to do that and not looking bad doing it. Oh, okay, the pitch itself. Yeah, the problem to be solved. Who was it? Was it Ben Horowitz who said he wants to invest in aspirin companies, not vitamin companies, right? In other words, it's a problem that really has to be solved. It's one of those must-have solutions, not one of those nice-to-have solutions. You might just think about it that way as you present to your company. The opportunity, just make sure, because I've sat through a lot of pitches, and a lot of times I hear the problem, I hear the solution, and I think, that's nice, but I don't know, do I really need that? And I think part of that salesmanship as much as anything else. Competition, resist the temptation to say that I have no competitors. That just doesn't go over well. It's unlikely, first of all. And you're probably thinking of the term competitors differently than other people. Think of alternatives, all right? When I say who are your competitors, think of your alternatives, because the investor is really, really going to want to know that you've thought that part through. And again, I've been through the pitches and then the debrief later when the VC calls me back and yells at me for not preparing my client good enough. And they say, hey, your guys shouldn't be saying they have no competitors. They've just not done their research when I say stuff like that. So, just think that through carefully. I've just seen people make that mistake because it sounds so good. It's so much hubris to say, we have no competition. There's nobody in the market like us. Resist that. Okay, we're kind of getting towards the end here, but we got another 5 minutes. So I'm going to get into things that I'm going to talk about a whole lot more in the next session. So when you go to the VC, that'll be oftentimes the first time that you do what they call a priced round. What is a priced round? That's an investment round that actually values your company, that puts a number on it. Okay, up till then, you've been doing these convertible instruments that we've been talking about, the SAFE, the convertible note, etc. You get to the VC, now they want to price it. In other words, they want for their money a certain percentage of your company. So they're going to do that with stock, not just any stock, but preferred stock. We'll talk a lot more about what that means later. But for now, understanding they're buying ownership in the company. Now, remember what I said about valuation. Don't put a number out, let them give you a number. And that's usually how it happens. You get a term sheet. You'll have some informal discussions, of course. But when it comes in writing, the first time you'll see it in writing will be in a non-binding term sheet presented to you by the VC. Like I say, every once in a while, you get an investor that wants you to prove your value to them. I've got about 30 different ways you can do that. You'll find 3 of them that converge on a number, and you'll go with that. It's discussed in my book if you want to hear more about it. And there's a few more of them. Okay, we talked about this already. By the way, how do you think the VC is valuing your company? Believe it or not, here is really a system that I've heard more than once. I've heard the VC say, this is how we value a company. We figure out how much money the company needs to get to that next inflection point. Remember we talked about that next valuation bump, you're going to double your value. Figure out how much money they need to get there. We figure out how much of the equity we want to have in this company. Poof, that's our valuation. All right, not very scientific, but I've heard that system used. That's why I say valuation has less to do with what you're worth than what the future looks like. I'm going to pause a little bit here before we get into venture capital terms and set the stage. And by the way, I've been seeing big funds and big VCs putting relatively big money, $5–10 million into convertible notes and safes. So I think we have to talk more about convertibles now when we talk about VCs than we did in the past. So what is a convertible note? Really, the investor loans you the money, but that loan will convert into stock at some later date when you finally issue stock in the company. A safe is just like a convertible note, except there's no obligation to repay it. So a convertible note, if the company doesn't do a financing and doesn't sell stock later, that note eventually is going to come due. The investor is going to demand repayment. You're going to have to repay. And if you don't, the investor could sue the company and they could end up owning the company. That can happen. I've seen it happen. Safes don't have that feature. Also, convertible notes have interest because they're loans. Safes don't have that feature either. The safe is that, look, here's my investor says, here's the money. We don't want your company, unless it's successful. So when you do that next financing, we'll get stock. When you sell the company, we'll get cashed out. If you don't do a financing, we just sit out there with our safe and we just wait until you sell the company. That's the safe, okay? It automatically converts typically when we do a financing. There's usually an optional conversion feature built in so that after a certain period of time, It could be converted at the option of the investor on a financing that doesn't meet certain requirements or on a sale of the company. Now, here are the two important things to think about in the safe. Number one, probably the most important feature, well, the second most, we'll say, most important feature is valuation cap. That's the valuation at which the note or the safe will convert, the maximum valuation. So let me set the stage for you in the last couple of minutes we have. The investor has given you money. They gave you $100,000. You're worth $1 million today. We're hoping you're worth 10 million when you do your preferred stock financing. And so the investor, is thinking at that point, gee, if this company is worth $50 million when it does its preferred stock financing, my $100,000 isn't going to buy very much because it's going to convert at that later valuation. I think because I got in early when the company is worth a lot less, I should get a minimum percentage of this company for my money, regardless of what the later investors pay. That's the valuation cap. It sets a maximum valuation at which that note or safe will convert. Okay, heavily negotiated. I can give you some rules of thumb in the Q&A if you'd like. Discount. The early investors also will get a discount. So I'm an investor, my $100,000, because I saw the future and I got in early. When I do convert it to stock, it should convert at a discount. So instead of paying $1 a share, I should pay 80 cents a share. That's a 20% discount, right? It's oftentimes phrased as 80% discount in the documents, but you get the idea. I pay less money for that stock in the round. The other thing to keep, and this is maybe the most important feature, is the idea of pre and post money in a safe. And I will just tell you that if you're a company, the pre-money safe is better for you just because of the way that the valuation cap is calculated. If you're an investor, the post-money is better. The post-money valuation guarantees you pretty much a certain percentage of the company. All right, so think about that. I buy a post-money safe for $100,000. Based on that valuation cap, I'm guaranteed to get at least some percent of the company. And that's whether you sell another $1 million worth of safes or another $100 million worth of safes. I still get the same post-money valuation. Obviously, that makes no sense if you have the kind of company that's selling lots and lots of safes over a long period of time, right? If it's a big number, right? It makes a lot of sense if it's really just a bridge loan or a proxy for a bridge loan. In other words, if you expect not to have a lot of safes and you expect to get to that round fairly soon. So I'm not saying never use a post money. Sometimes it's the right answer. Just generally the pre-money is a little bit more favorable to the company because the pre-money says that the safe investor is going to get diluted by every other safe plus option pool increases usually, not always, but they're going to get diluted by additional safes as we go along. So the pre-money safe investor, they have no idea what percent they're going to have. And I hear people debate this, pretty fiercely on all sides. If your investors say, hey, look, I don't want some lawyer down the road sitting down and explaining to me how I got diluted way down to almost nothing by later financings. I need a post-money safe. I need to be guaranteed this percent. And from my standpoint, it's like I say, that makes perfect sense. If we don't take very much more safe money in, it's hard to get my head around if we are planning on, like a lot of companies, just doing rolling safe financings forever and ever, which is not a good strategy. So convertible debt works about the same way. We'll talk more about that later, and I'm going to drill down into this next month when we do part 2. But for now, I'm going to go ahead and conclude this portion of the presentation and open it up for questions. I do want to let you know that the next presentation, we're going to get real deep in the weeds on venture capital terms, right? We're going to get deep in the weeds on what these terms mean and how they play out and what they mean to you. But for now, we are going to go to questions. So let's open up the Q&A and see what we got. Well, we got a lot of questions. Holy cow. Thanks for hanging with me. Okay, question number one. I came in at 9:06 a.m. So that was early on. Is there a good rule of thumb as far as how many shares to declare during registration of a Delaware C corporation? Okay, so let's talk about that. We do a whole thing on forming a startup and choice of entity. And if you're here, you've probably seen that. And, we almost always start with a Delaware corporation, what they call a Delaware C corporation. There's a lot of reasons for that. If you want me to, I'll go into it, but suffice it to say, that's what venture capitalists want to invest in. So that's where we start. And there's a lot of other good reasons for starting there as well. How many shares to declare? So the corporation will authorize a certain number of shares, and you'll go tell the Secretary of State, this is our authorized number of shares. What does that mean? That means that's how many shares the board of directors of that corporation can sell without having to go back to the Secretary of State and asking for permission to sell more. And it's not really permission, you just file a notice or an amended certificate. So my rule of thumb is 10 million. I start with 10 million, okay? And here's why. 10 million, I want to give about 8 million to the founders and leave another 2 million available for service providers, employees, contractors, stuff like that. I like those numbers for a couple of reasons. First of all, when you do get an option plan, or even before then, when you're just issuing shares to service providers, you can have a high enough number of shares that you look a lot like all the other startups in the neighborhood. So they don't have an option for 10 shares while their buddy has an option for 1,000 shares, for example. You both want an option for about the roughly the same kind of number. I guess it's more psychological than anything. It's more optics than it is logic, but that's where I start. Now, because if you have a high number of authorized shares, then you can have, a relatively high number of shares that you can issue to people, and it makes them feel better. The other reason I like that number is Delaware has a really funny tax system. You're not going to pay income tax in Delaware unless you actually have an office or are doing business there, but you will pay a franchise tax to the Secretary of State. The way that tax is computed is really odd, and it surprises people. It's counterintuitive, and you should let your accountant do it. But I want to, as a general rule of thumb, for a company at startup stage, you want to have just a small spread between the authorized shares and the issued shares to keep that number down. Okay, when the company gets bigger, that number gets humongous, but for now, it doesn't have to be. It should only be a couple $100s. Now, you might be saying, gee, if that's true, that having a high number of authorized shares makes all my employees feel good because now they've got a lot of options, why not 100 million shares? Okay, well, I will tell you why. For a couple of reasons. Number one, you want to look like you're in the same ballpark with everybody else. You don't want to look silly, right? You don't want to have your programmers having an option for 1 million shares when everybody else has an option for 1,000 shares at their level, or 10,000, or whatever it is. You don't want to look way out of market. It just looks like there's something really wrong, going on, or maybe you're trying to pull a fast one. Secondly, your investors might come in and say, we don't like that. We want you to do a reverse split. A reverse split is where you reduce the number of shares outstanding. You just split them, you reverse split them. Every 2 shares equals 1 share now. Same percentage of the company, lower number of shares. You don't want to do a reverse split. That sends a really bad signal to the market that somebody screwed up. So I don't like using those big numbers. And that's one of those mistakes that you can go out and do it yourself if you go online and use an online incorporation tool with no advice. So I'm glad you're here, and I'm glad you're asking these questions, because I've seen companies do this. It's not the end of the world. It's not the biggest deal, but still, it's a little thing, but I like to get it right. So that's where and by the way, you eventually will get to 100 million shares. Your company gets big, you start having real value, big value, that number of shares keeps going up with every financing. So eventually you'll get there, but don't do it today. Okay. Well, this is interesting. It's not really a question, but a comment. It says, I'll just read the comment. I don't know if this is true or not. 96% of cryptocurrency participants have not filed tax returns, and their transactions are transparent and visible in the blockchain. Yeah, it has nothing to do with my presentation, but I think 96 might be high. I will tell you, I am a tax and corporate lawyer, so yeah, don't, file your tax returns, pay your taxes. If I talked about NFTs earlier, if you've got big gains, don't think that the IRS is not going to find it. What are your thoughts about using the DAO as a startup legal structure? Wow, interesting question. I've been studying the DAO recently. The DAO is decentralized autonomous organization. And when it started out, it was the idea, it arose, of course, from the crypto world. It's the idea that you could get people together just in code, right? Not having an entity, but we just have people have tokens or crypto assets, cryptocurrency, digitized ownership of a certain asset. So you could pool a bunch of people together, and they could maybe invest in something, whatever that asset is. These days, I'm seeing it being proposed for investment funds, for example. And the code is law, and basically the members through this organization have a right to control the organization digitally. That's the DAO. The problem with that is that I think for legal purposes, that would be treated as a general partnership. So if something were to go wrong with whatever that activity is, that this pool of people have come together out in the internet to conduct whatever that operation is. If something goes wrong, each one of those people could have liability. I think that's the problem. Okay, so Wyoming has solved that problem by creating a limited liability company just for the DAO. So you create a DAO, and then you create an LLC that actually is the DAO. I don't know how else to say it. Let's just say Wyoming has solved the problem. I actually think Delaware has solved the problem way before then. I think you could do a DAO through a Delaware LLC just as easily, probably more easily, because I can tell you Delaware LLC law is really super friendly and flexible. So I think I prefer a Delaware LLC for a DAO. I prefer an LLC generally for a DAO. If you're going to let everybody in the organization have a right to governance, that's fine. If you want to do it through distributed ledger, that's fine too. But I think that ought to be within a legal structure. So that's my comments on it. But I do think that's the future of a lot of organizations. I think, we're really onto something here. What about prop tech? Thank you. I should have mentioned property tech. Holy cow, how did I forget that one? Prop tech is really hot. They're just popping up everywhere. And I don't know why now. I've been working on property tech startups for 15 years. The timing just was not right. We just couldn't get the market to accept it. And all of a sudden now people are accepting it. I think COVID might have had a lot to do with that. I think housing problems might have a lot to do with that. They tell me Elon Musk doesn't even live at home anymore. He just couch surfs with all his friends. I don't know if that's true or not, but just the fact that, people are doing more shared living now than they used to. But yeah, absolutely. Property tech is really hot. So how about in the context of ESG goals? I'm not quite sure how that fits in, but I'm sure there is a way to do that. By the way, if you have questions, put them in the Q&A box. I'm not going to go back to the chat for a while here. Let's see, what else? Which VC should we approach and how should we approach them? Do we need a credible introduction? Okay, I'm glad you asked. So the VCs that you approach should be, and by the way, we do like a whole hour, on this topic, how to know which VCs to approach and how to approach them. But, and you can find a video on my YouTube channel. But the ones you should approach are obviously the ones that invest in your sector at your stage and have some dry powder. Okay, dry powder means they have some money, that they're able to invest. By the way, that is one of the more unhappy trends that I've seen in venture capital investment. more money has been going into later rounds than earlier rounds the last couple of years. That doesn't mean there's not a lot of money in early rounds. It means a lot more VCs are just making later investments. They're doubling down on our existing companies rather than seeking out new ones. That's my interpretation anyway. Anyhow, the most credible, so once you've identified those VCs, and they're not hiding, the bigger they are, the more, the more they're out there. But once you've identified them, you might look who they've invested in. And, did they invest in a competitor of yours? That might be a bad fact. It might not be. In any case, if you think they're a good candidate for your company, the absolute best introduction you can have is through the founder of one of the companies that they've already invested in. That's the best introduction. Okay, that is great social proof. That means somebody that really understands that VC and hopefully knows you and your company is vouching for you and is saying, look, you guys are a fit. Other than that, a warm introduction is really important. We're doing live events again, so nothing beats meeting people in person. I like to tell the story here about one of my venture capital clients who got a pitch deck and was introduced to, I don't want to name any names because this is actually a pretty popular story. It's out there in the books now, but got introduced to a company that was pretty radical what they were doing. It was not something you would expect would be a great idea. And the VC, she turned it down. Even though she does consumer and it was her space, she said, I just, just didn't think it was right through the pitch. And then later ran into that same individual at a social event and got to talking with them outside of the pitch deck. And based on that interaction, she came back and she said, I changed my mind. I want in on this deal. And that company became a unicorn and it exited. It was a huge exit. So, meeting people in person, I think there's just no real substitute for it. And I know we're all doing everything by Zoom now, even pitch meetings. But, there's a good example of where, meeting people in person is way better. Goes the other way too. I've heard VCs say, I financed these guys. I met them on Zoom. It was during COVID. I gave them money. I didn't meet them till afterwards. And if I had met them in person, I never would have given them money. So just take that for what it's worth, What percentage of shares do you suggest to allocate for an option pool? I like to start with 20%. The range is between 10 and 30. I start with 20 because the VCs are going to make you go to 20 anyway. And by the way, 20 out of your share of the company when they put their money in, and 20 post their money. So let's just start for 20 and we'll negotiate from there. I don't like going more than that because that's going to increase your Delaware tax. Not a lot, but enough. And plus it's going to look a little outsized, I think. 30 I would live with. If somebody were planning, if they had plans how they were going to use it. By the way, the size of the option pool, why is that so significant? It's just a pool, right? We're not issuing those shares. We're just setting it aside. We're just going to grant it later. Why is that such a big deal? Because it goes into the fully diluted number of shares of the company. So when investors come along, or even safe investors, when you negotiate what percentage they're buying a percentage of the fully diluted capitalization. That fully diluted capitalization includes not only the shares issued to you and the founders and all of your friends and family, but the shares reserved under your option pool. So the bigger it is, the bigger percentage the investor is getting. That's why it's a big deal. Let's see. This is interesting. What kind of communication is required between current stakeholders before moving to VC rounds? Yeah, so we do a whole thing on angel investing, and it kind of depends on your current pre-VC investors. So some angels, they don't care. They're in for a small amount. They just want you to get there. They don't need you to report to them. Others are going to be very involved in this process. The smarter ones will have asked for pro rata rights. What's a pro rata right? That's a right that the early investor has to to participate in the later financings. And I'm seeing that more and more and more now. In other words, early investor says, look, when you go to the VCs, you have to let me buy some stock so I can maintain my percentage interest. This can get to be very complicated. I'll just warn you as to how we calculate that. But it's a pretty common thing now. It's almost in every deal. And those investors, of course, are going to be very interested in what you do with the VCs because you're going to have to give them notices and they may want to spend some money. All right. What is, I don't quite understand the question. It's about the best equity amount to give away to avoid too much dilution. If you're talking about to the VCs, again, they're going to tell you when you get your term sheet, but you know, I've seen between 10 and 40 for an A round, a Series A round, and then you got all the convertibles on top of it. So you're giving between 20 and 40 away by the time you're done. My rule of thumb with that, by the way, is I'd like to see the entrepreneur maintain control after the Series A, right? I want you to have more than 50%. I want you to have 2 out of 3 members on the board of directors. After the Series B, you're probably going to give up control. But after Series A, stay in control. So that's another way I think about these percentages, just rules of thumb. Yeah, what percentage of the founders go with pre-money safes versus post-money safes? I actually do have data on that, and I don't carry it around in my head. But I'll tell you what, if someone wants to email me after, I can actually give you the stats because there are statistics. In fact, if you go on some of the cap table tools, they'll just tell you how many of their safes are pre and how many are post. I can tell you anecdotally for me, most of my pre-money, most of the safes I work with, because I usually work with companies, most of the ones I deal with are pre, probably 80%. I think for Investors Council, you know, it might be more like 50%. But I think the tide is turning away from that post-money safe, to tell you the truth. Do you have a checklist for the due diligence info? Yes, I do. And by the way, like I said, get yourself a data room as soon as you can, organize it into folders, start storing signed agreements and signed copies there. It'll just make life a lot faster and easier when you finally do get to your event. When do the safe investors get to sell shares? Well, keep in mind, a safe investor is not getting any shares until they convert into shares in the preferred stock round. And then they're going to be locked up for a number of reasons, right? There are going to be contractual restrictions. There'll be rights of first refusal on those preferred shares. There'll be securities related restrictions. There's a Rule 144 holding period. So they'll be restricted. Even after we get past the holding periods, they might want to sell their shares in what we call a secondary sale. In other words, it's not a issuer sale from the company to the public, to a buyer. It's from the shareholder himself to a buyer. So that's a secondary sale. And let me just pause on this for a minute because we're seeing so many secondaries now. You've heard of equities in, we're just seeing so much of that. Well, at that point, they'll go to the company and say, dear company, please release me from my right of first refusal. So and a right of first refusal is a right of first refusal is a right by the company to purchase any shares that a seller wants to sell to a third party. So if I'm a shareholder and I want to sell my shares to somebody, I notify the company, and then the company has a right to buy those shares. That's what keeps people from selling shares. So you, the selling shareholder, will go to the company and say, please give me a waiver so I can sell my shares to this third party buyer and I can get rich. And oftentimes the company will say, okay, fine, bring me a letter from your lawyer that says you have no securities related restrictions, and we'll go ahead and we'll consent and we'll let you do that sale. Maybe you don't have a right of first refusal, so you don't even have to go through that, but you still have the securities related restrictions. Sometimes the company will say, no, we don't want our stock being held by anybody else. We're not going to release you. Then you go out to a completely different market. And there's a completely other market of secondary buyers out there that trade in derivatives. and they'll take futures and forwards and options and contracts and all sorts of stuff that are way beyond the scope of what we're talking about here. So the smarter companies have figured out how to stop that from happening if they care. The SEC looks very hard at these transactions. They'll just warn you once they get to be above a certain volume. And then finally, we have Dodd-Frank restrictions, not to mention the tax issues all over the place. Yeah, don't get me started. But let's just say selling in a secondary market could be really easy, or it could be a huge production that's going to take a lot of my time. I do a lot of those. All righty. Okay, here's a good question. When doing crowdfunding with a pre-money safe, what should one keep in mind in order to avoid ruining future rounds of funding? So I'm going to raise two issues for you. Number one is you have to pay attention to state blue sky laws, and it seems like nobody does, and everybody should. And I think they don't because the numbers are so small. They say, who cares? But I care. I'm a lawyer. I want it done right. So, make sure you have company counsel on your side watching the securities law issues, not the federal issue, not only the federal issues, also the state. And yes, I know that these securities are carved out from state restriction, but many states still have a notice requirement. That's a real kind of gotcha. Secondly, here's the problem that I run into with the safe. And I don't think there is an answer, by the way, and this is way up there in esoteric legal land, is that your pre-money safe by its terms is going to convert into a security when you do your preferred stock round. Well, that preferred stock round is likely to be an accredited only round. So your pre-money safe investor may not be an accredited investor. So do they have to be accredited to convert, or are they relying on this rule that says that they don't have to be accredited because they didn't have to be accredited when they bought the safe? Well, I think we have to take a hard look at these issues. And one of the things I've seen the market do to deal with it is that the safes get cashed out at some point down the road, or they convert into something other than the accredited only round or some other vehicles. But I think there's a little bit of a legal issue there that has not yet been fully resolved as to how we deal with the securities law rules with respect to a convertible. That's all I'll say about it. But I will say that the market has come up with what it thinks works. And you can see it on all the major crowdfunding sites. The crowdfunding safes are all set up to deal with that issue now. They weren't at first, but they are now. What's your view on super voting shares? So super voting shares, here's the idea. Founder, say you're Mark Zuckerberg, because he did this. He says, I'm such a great founder, I should have 10 votes or, oh hell, 100 votes for every share of my stock as every other common stockholder, so that I can impose my wisdom on this company. And I see companies do that, and I get that. Just be prepared to give that up when you go do your financings. And I understand why you want to do it. I'm just saying I view it as a temporary fix. It gives you control over your company early on, but investors are not going to like that. They're not going to have that one person having that much control, possibly. So be prepared for that. I tend to discourage it because it's, first of all, you shouldn't be giving away so much of your common stock early on that you don't have control of the common before you get to a financing. There's something odd going on in your cap structure if that's what's happening. We need to figure out what that is. You might have a bigger problem, let me put it that way. Maybe you're selling common to raise money, which is something you never want to do because the common price is really low. Preferred stock price is high. If you sell common to raise money, you're giving up too much of the company. So I would probably solve some other problem before I would do super voting. And then secondly, I think it's someone's going to make it go away. Someone asked, how long are the safe investors locked up? So there are these things called the securities law restrictions. It's called 144 restrictions that typically lock up stockholders for a year after they buy before they can do a distribution. So just think of it as a 144 1-year lockup, 6 months or a year, depending who you are. Okay, let's see what else we have here. I'm going to turn now. I know there were some questions in the chat. And I said I wasn't going to read them, but I want to make sure. Okay, there's a question about safes. We got that. Formula, is there any formula as to the best ratio of cost and price as an acceptable minimum? Sorry, I do not understand your question. If you're talking about how to price the round, then like I say, we've talked about that's valuation, and you're going to have a long discussion about that. All right, let's see what else we got here. All right, safes. A lot of questions about safes coming through. So let me talk a little bit more about that in the last couple of minutes we have. I went over the biggest three things about the safe. One, pre-money or post-money. Okay, we talked a little bit about that. We can go more into that next time if people are really interested as to how those numbers change. Second is the discount rate. It's usually 20%, and it fluctuates from there. And it might be a negotiation against some of these other things. Third thing is what we call an MFN clause, most favored nation. And that's a clause you sometimes see in a safe or a side letter that says, if you do another safe that's got better terms than this one, you'll give me the benefit of those better terms. You oftentimes see that. And then finally, you might see pro rata rights, which we talked about. That's the right of the safe investor. We do like a pretend if the safe were convert right at the financing, right before the financing, what percent does a safe owner have? And then they get to buy that many shares in the financing. It's that sort of calculation. You'll see pro rata rights, but then the safe will convert and they'll get the same pro rata rights that the stockholders get who buy stock. So really they're getting pro rata rights in the next round, the Series B round. That's what we typically mean. What are the other provisions? More and more, I'm seeing protective provisions come up. I want to be in your board of directors. I want to be an observer. I want information rights. The Y Combinator form even offers dividends on safes. So it's starting to look a lot like stock at that point. I don't know if I care because my startup companies don't pay dividends. It'd be foolish to. They're not that, remember what we said, they don't have earnings, they have growth. So I don't care much about it, but it is, I do think it's an odd provision. Okay, with that, we are past 10:30. I want to thank you for all your questions. Thank you for being a good audience. You're going to get an email from me that has a copy of these slides, a copy of this recording, a soft copy of my book, 10,000 Startups. And I look forward to seeing you next time.